So now you know the layout for the two financial statements of sole traders. The next thing to get your head around are the adjustments. So here's a list of the main adjustments that are most commonly going to come up. So first one, depreciation. So remember, there's two types of depreciation. There's the straight line method, which is like simple interest, where it's the same number each year, the same amount of depreciation each year. So it's either the percentage of the cost, so the straight line method, it's either percent of the cost, or you can work out how much it depreciates by the cost, take away how much it's worth at the end, divide by how many years. Or you have the reduce and balance method, which that's where you do the percentage of the net book value. So the depreciation changes each year, it's a different number each year. So what we would do to depreciate something, you first of all work out what this year's depreciation should be. And then once you've got that number on the income statement, that's where you would list it as an expense, so the yearly one. And on the SOP, the statement of financial position, you would go to the non-current asset and the provision for depreciation that increases by this year's. So we add on this year's depreciation. Yeah, we add it on. Yeah, so the provision should always be bigger than the yearly one, because the provisions every year up until now, whereas the one on the income statement is just this year's. Okay, then we have an accrual of expense. So that means where you owe some money for one of your expenses, you haven't paid it yet. So what you do for this is on our income statement, we have to include everything we should have paid for this year. So all the expenses that would have been this year. So on the income statement, you would go to the expense. So let's say it was rent paid. And since it hasn't been paid, but it should have, what we do is we add it on. Yeah, we say that's what we should have paid that year. And then on the soft, since it's something we owe, we go to our current liabilities. We find where it says other payables, and we add it onto that. Prepayment of expense is kind of the opposite. Prepayment of expense is when we've paid in advance, so we've paid a bit extra of an expense. So we paid a bit of next year's. So on our income statement, it should only be this year's that's included. So let's say it was our telephone bill. Then what we do is the bit we prepaid, we minus it, we subtract it from there, and we'll include it on next year's. But this year we're going to minus it. Then we go on to our soft, we go on to our current assets, because since we prepaid it, we've got that extra money. So it's an other receivable, and we add it onto there. If there's already a number, if there's not, then we create an entry for other receivables. Okay, for income, the work's similar. So an accrual of income, that means we're owed income. We haven't been paid everything we should have been paid. So on our income statement, remember we list all the stuff that we should have got that year. So let's say it was rent, then we should have received the rent. So we're going to add it on to the rent received. Now on our soft, since we haven't received it yet, but we should have received it, it's an other receivable. It's something we're owed. It's owed to us. So we add it on to other receivables as well. So other receivables, look, are made up of two things: prepayments of expenses and accruals of income. And then we have prepayment of income. So prepayment of income, this means we received too much income, so someone's prepaid us a bit for next year. So on our income statement, let's say it was commission received, since the paid is a bit too much, we're going to take it away and we'll put that amount on next year's income statement. Then on a soft, we've got the money now, however, technically now we owe it to them because it shouldn't have been paid this year. it's a current liability. So other payables, it gets added onto there. So other payables are made up of two things. They're made of accrual of expenses or prepayment of income. Okay, next one we have is irrecoverable debts written off. So that's when we write off someone's debt because they went bankrupt or there's no chance of getting the money back. So this one's nice and straightforward. So on our income statement, we list it separately under irrecoverable debts written off, and we put it there. And then on our trade receivables, we would minus it from there if we haven't already. If, however, in the future, we manage to recover it, so we manage to get some of the money back that we were owed after we've already written it off, then what we do is, again, on the income statement, it's an income because we're receiving some money. So we list it as recovery of irrecoverable debts down here. And on our SOP, what we do is we don't adjust the trade receivables. What we do is we adjust the bank or the cash because it's money we're getting. So the bank and the cash goes up, it increases by that amount. And the last one, doubtful debts, if it's an increase or decrease or whatever the change is. So it's a bit like the depreciation. So we find out how much this year's provision has changed by, and that goes on our income statement. So if the provision for doubtful debts has increased, then that's an expense. If it's decreased, then that's an income. Remember, the provision, it's kind of like putting some money aside, figuratively speaking, and if that decreases, well, that's an income, kind of getting some of that money back to pay with. If it increases, we're losing some more money because we're putting some money aside, like I said, metaphorically. And on our SOP, what we do is we take away the whole provision. Yeah, not just this year's, the whole provision, the current provision, we take away from the trade receivables. So, for example, say last year's provision was £1,000, this year's is 1,100. Then it's went up by 100. So we would put it as an expense, it's increased by 100. But here we will put 1,100. We would put the total. Okay, now I hope that's helped you a little bit with the main adjustments. All the other stuff would be errors, and you've looked into errors now, so you should be able to tackle most of the questions on income statements and statement of financial positions, and these get you lots of marks. Right, give the exam questions a try.